If you're retired, approaching retirement, or somewhere between 50 and 70 and depending on Social Security, Medicare, a pension, or your investment portfolio, there is a financial number you should understand right now: $40 trillion. The United States has crossed the $40 trillion national debt threshold, reaching roughly $40.047 trillion in August 2026. That is an enormous number. But the number itself is not the most important part of this story. The real question is what happens when a government carrying that much debt has to keep borrowing while interest costs rise. Social Security and Medicare spending increase, and millions of Americans are depending on those programs for their retirement security. And there is something important to understand immediately. $40 trillion of federal debt does not mean Social Security is suddenly going away. It does not mean Medicare is disappearing next month. And it certainly does not mean retirees should panic and change their entire financial plan overnight. What it does mean is that the financial environment surrounding retirement is quietly changing, that interest rates matter more, federal budget decisions matter more, inflation matters more, taxes matter more, and the difference between a retirement plan that has a comfortable margin and one that barely works becomes much more important. Once you see the numbers clearly, you'll understand why this matters more than most people realize. Let's zoom out first. When you hear that the national debt has reached $40 trillion, it is tempting to think of the number as one giant bill that somehow has to be paid off by American households. That isn't really how the federal government operates. The debt represents accumulated borrowing over many years. It includes debt held by the public, as well as government accounts that hold Treasury securities. As of the latest reporting, roughly $32.3 trillion was publicly held and about $7.8 trillion was held in intragovernmental accounts. So the useful question isn't, how is America going to write a $40 trillion check? The useful question is, how much does it cost to carry this debt, and what does that cost compete with? That is where retirees should pay attention, because when the government has to devote more money to interest payments, that money cannot simultaneously be used for another purpose. And according to recent reporting, federal interest costs have become larger than Medicare spending and are now one of the largest items in the federal budget, behind Social Security. Think about that for a moment. The government isn't simply dealing with the amount it borrowed in the past. It is also dealing with the cost of financing that borrowing today. And this is where interest rates become incredibly important. Long-term Treasury yields have recently moved to levels not seen in many years. The 30-year Treasury yield reached about 5.34%, a 19-year high, while the 10-year Treasury yield has also been elevated. For the average retiree, that might initially sound like Wall Street information. It isn't. Treasury yields influence mortgage rates. They influence corporate borrowing costs. They influence bond prices. They influence the returns available on safer investments. And they influence how expensive it becomes for the government itself to refinance and issue new debt. So there are two sides to the equation. Higher yields can be painful for borrowers, but they can also create better income opportunities for savers who hold cash, Treasury securities, or other fixed income investments. That distinction is extremely important. The $40 trillion headline is not automatically good or bad for every retiree. The effect depends on which side of the financial equation you are standing on. If you're carrying expensive debt, rising rates can work against you. If you're sitting on substantial cash or short-term fixed income investments, higher yields can work in your favor. And if you're heavily dependent on long-term bonds, rising yields can temporarily push the market value of existing bonds lower. This is why simply reacting to the headline can be a mistake. Now, let's connect the national debt directly to Social Security. The 2026 Social Security Trustees Report says the Old Age and Survivors Insurance Trust Fund is projected to become depleted in the fourth quarter of 2032. The combined Social Security trust funds are projected to become depleted in the third quarter of 2034. Under current law and the trustees' intermediate assumptions, 83% of scheduled combined benefits would be payable at that point if no legislative changes were made. That statement is often misunderstood. Trust fund depletion does not mean Social Security becomes zero. It means the system would no longer have enough reserves to pay 100% of scheduled benefits from the trust funds. Payroll tax income would still be coming into the system. The trustees estimate that the combined system could pay about 83% of scheduled benefits at the time of projected depletion, absent legislative changes. That is still a serious gap. But it is very different from saying Social Security disappears, and this distinction matters because your retirement plan should be built around realistic scenarios, not internet headlines. Now consider the same issue with Medicare. The 2026 Trustees Report projects that Medicare's Hospital Insurance Trust Fund will be depleted in the second quarter of 2033. At that point, about 89% of scheduled hospital insurance benefits would be payable under the trustees' projections if no changes were made. Again, depletion is not the same thing as Medicare disappearing, but it does mean the program faces a financing problem that policymakers eventually have to address. And here's where the $40 trillion debt becomes relevant. The federal government is dealing with multiple long-term commitments at the same time. Retirement programs are growing as the population ages. Healthcare costs are substantial, interest payments are rising, and the government continues to operate with significant annual deficits. These problems interact. That doesn't tell us exactly what Congress will do in the future. Nobody can honestly predict that with certainty, but it does tell us that retirement planning cannot simply assume today's tax rules, benefit formulas, interest rates, and healthcare costs will remain unchanged for the next 30 years. This is where most people get caught. They build their retirement plan around one number, their Social Security benefit, or their pension, or their 401k, or the value of their home, but retirement is not one number. It's a system. You have income on one side. You have taxes, healthcare, housing, food, insurance, and debt on the other. And inflation sits in the middle, quietly changing the purchasing power of everything. Imagine two households approaching retirement with identical Social Security benefits of $3,000 a month. On paper, they look identical, but one household has a paid-off mortgage, no credit card balance, manageable property, taxes, and $500,000 invested. The other still has a mortgage, a car payment, revolving debt, and only $150,000 saved. The same $3,000 Social Security payment produces two completely different retirement experiences. That's the median versus average problem people often overlook. A national statistic tells you what is happening broadly. It doesn't tell you whether your household has enough margin. And when financial conditions become less predictable, margin becomes more valuable. This is also why the recent rise in Treasury yields matters beyond government finance. Reuters recently reported that elevated long-term Treasury yields are raising borrowing costs across the economy, including mortgages, while also affecting stocks and corporate financing for a 62-year-old homeowner. That could matter if they plan to refinance, move, downsize, or help an adult child buy a home. For a 55-year-old investor, it could matter because higher bond yields can change the relative attractiveness of stocks versus fixed income. For a 70-year-old retiree, higher yields may create opportunities for income-producing assets, while simultaneously creating risks for existing long-duration bonds. The impact is not identical. Now, here's the tension point. The mistake that quietly costs households thousands is assuming that because something is safe, it is automatically safe for every time horizon. A Treasury bond can have very low credit risk and still experience price fluctuations when interest rates change. Cash can feel safe, but inflation can gradually reduce its purchasing power. Stocks can produce long-term growth, but their short-term volatility can be uncomfortable. Someone withdrawing money every month, and Social Security is an important income source, but relying on one government program for the majority of your retirement income leaves you exposed to future policy decisions. The goal isn't to eliminate risk. The goal is to understand which risks you are actually taking. Now consider two households. The reactive household hears that debt has crossed $40 trillion and immediately assumes the worst. They move everything into cash, stop investing, make emotional decisions about Social Security, or begin searching for some dramatic way to protect themselves. The strategic household does something different. They ask, how much guaranteed income do I have? How much do I need each month? What are my fixed expenses? How much debt do I carry? How much of my portfolio is exposed to stocks? How much is in shorter duration fixed income? What happens if inflation stays higher than expected? And what happens if Social Security policy changes? That household isn't predicting the future. They're preparing for multiple versions of it, and that is a much stronger strategy. If you're 30 and renting, the $40 trillion debt headline probably shouldn't change your entire financial life. Your biggest advantages are time, earning potential, and compounding. Your priority is building productive assets, keeping high-interest debt under control, and gradually increasing your retirement savings. If you're 50 and behind on retirement, the situation is different. You have less time for mistakes to recover. That makes your savings rate, debt reduction, investment allocation, and expected retirement age more important. You may need to calculate what happens if you work 2 or 3 additional years instead of assuming retirement begins automatically at a particular age. If you're nearing 62 and thinking about Social Security, don't make the decision simply because you hear that the system has a projected funding problem. Study your actual benefit estimates, understand how claiming age changes your monthly benefit, and compare that income against your household's expenses. If you're already retired, the question becomes even more practical. How many years of expenses can your liquid assets cover? How much of your monthly income comes from guaranteed sources? What happens if healthcare costs are higher than expected? And how much flexibility do you have if markets decline during the first few years of retirement? Those questions are far more useful than simply asking whether $40 trillion is a scary number. So what can you actually do this week? First, calculate your household's essential monthly expenses, not your ideal lifestyle budget. Your essential number: housing, utilities, food, insurance, healthcare, transportation, and debt payments. That number gives you the foundation for understanding how much guaranteed income you really need. Second, log into your Social Security account and review your benefit estimate. Don't rely on an old statement sitting in a drawer. Look at the current information available to you and compare different claiming ages. Third, calculate how much of your retirement income would disappear if Social Security provided less than your scheduled benefit in the future. You don't have to assume that scenario will happen. Simply test it. If your plan collapses under a modest reduction, you've identified a vulnerability early. Fourth, examine your debt. If you have high-interest variable rate debt, rising interest rates can become a direct threat to your cash flow. Reducing expensive debt can sometimes provide a more certain benefit than chasing a higher investment return. Fifth, review your fixed income exposure. If you're approaching retirement, understand the difference between holding individual bonds to maturity and owning bond funds whose market values fluctuate. The objective isn't to avoid bonds or stocks. It's to make sure your portfolio matches the time horizon of the money you're investing. Sixth, review your tax picture. A retirement plan isn't finished when you calculate gross income. You need to think about taxable withdrawals, Social Security taxation, required minimum distributions when applicable, Medicare-related premium considerations, and the interaction between different sources of retirement income. The rules can change, so don't assume a strategy that worked several years ago automatically remains optimal. And seventh, build a margin. If your retirement plan only works when inflation stays low, markets rise smoothly, healthcare costs remain predictable, and every government benefit remains unchanged, that's not really a resilient plan. It's a best-case scenario. A resilient plan has room for surprises. That doesn't mean hoarding cash or living in fear. It means creating enough flexibility that one bad year doesn't force you into a permanent financial mistake. And this brings us back to the $40 trillion number. The most important lesson isn't that America is about to collapse. There is no responsible evidence for that conclusion. The lesson is that the financial system is becoming more expensive to operate. The government is paying more interest. Long-term Treasury yields are elevated. Social Security and Medicare face long-term financing challenges. And households are dealing with their own mortgages, credit balances, healthcare costs, and retirement needs at the same time. That combination makes financial margins more important. It also makes financial literacy more valuable. The future isn't predetermined. Congress can change taxes. Congress can change benefits. Economic growth can surprise on the upside or downside. Inflation can move differently than expected. Interest rates can fall as well as rise. Markets can recover from periods of stress. And higher Treasury yields can actually create better income opportunities for savers. So the correct response isn't panic. It is preparation. Your retirement security ultimately comes down to the difference between what you control and what you don't. You cannot personally control the national debt. You cannot control congressional legislation. You cannot control the Federal Reserve. You cannot control inflation, but you can control how much debt your household carries. You can control how much you save. You can control how diversified your investments are. You can control how much fixed income you need. You can control whether you understand your Social Security options. And you can control whether your retirement plan has a margin for uncertainty. That's the bigger lesson behind $40 trillion. Big numbers make headlines, but small percentages applied to your own household can determine your financial reality. A 1% difference in annual expenses, a few years of additional saving, a manageable debt balance instead of a large one, a thoughtful Social Security claiming decision, the portfolio designed around your actual time horizon. Over 10, 20, or 30 years, those small decisions can compound into enormous differences. So don't look at $40 trillion and ask only, should I be worried? Ask a better question. If the financial environment changes over the next decade, how prepared is my household to adapt? Because the households that remain financially stable aren't necessarily the ones that predicted the future perfectly. They're the ones that built enough flexibility to handle a future they couldn't predict. And that may be the most important retirement strategy of all. If you're retired or preparing for retirement, I'd like to know your perspective. Do you think the growing national debt changes the way you think about Social Security, Medicare, taxes, or your investment strategy? Or are you focusing more on the things you can personally control? Leave your thoughts in the comments. And if you want clear, calm explanations of the financial changes that can affect retirement, Social Security, Medicare, taxes, and household wealth, consider subscribing. The goal isn't to predict every headline, it's to understand what the numbers actually mean and make better decisions because of it.